Good day, everyone. Dr. David Phelps here, the founder and CEO of the Freedom Founders Community. Back again to you with our Real Wealth live stream this week, talking about what is wealth. Is wealth just money in the bank? Is it just a pile of assets? Is it money in a 401k, a capital account? Well, that's part of it. But the key, I believe, to real freedom, and that's what money's about, or wealth is about. Real freedom comes from optionality. And how do we make that money, the capital that we have worked so hard for, how do we make it actually replace our need to labor? Now, I'm not about exiting to the beach or the golf course. I'm always going to be involved in something, but to have the options to be able to do what I want to do when I want to, I've got to have something that's producing income that I don't have to go work for every day. To me, that's what real wealth is about. And I'm really pleased to have today with me Mr. Nate Hare. Nate and I go back, I hate to say how many years, Nate, but it's at least a couple of decades. I think I look worse for the wear than you do. You always look like you're still like 17 years old. I don't know how you do it. I know you're not 17 because the wealth of information and the connections that you bring through your work as a self-directed custodian, directed IRA out of Phoenix, Arizona. We're going to talk about that because we've got a broad audience today. I know we've got a lot of people that are interested in like, what are you guys doing about wealth in this? And what I want to focus on with you, Nate, is what you know so well, the back of your head. Certainly you are an investor on your own. I mean, you are an investor like all of us, trying to figure out where to put your capital, but specifically in the retirement account mode. And most people know something about retirement accounts. They might have a 401k at their work. They may have been able to open a traditional IRA at a brokerage or a bank account. A Roth IRA, many people are familiar, have some familiarity. I want to start with you just from a high level, Nate, with your years of experience. Why do you believe it's important today for more people, both young and old, or older, I just want to say older, to be more intentional about how their money, whether it's in retirement accounts or not, but retirement accounts, to be more intentional about how that money is being deployed, invested, and how we can do it in an environment that the government gives us to be more beneficial from a tax-wise basis?
Yeah, I would say in my 13 years of experience, directly focused on educating investors how to use retirement accounts and specifically self-directed retirement accounts. You know, what you seem to find with people and retirement accounts is that a lot of people view their retirement account, whether that's their 401k, their TSP, their IRA, they almost view it like casino chips. It's not real to them until they get to retirement. But the fact of the matter is, it is real. And a lot of people need to understand that you could be more intentional with what you own in your retirement plan. And there's more options for you to own different types of investments than just stocks, bonds, and mutual funds. But most people just don't get that information because most people have a retirement account through their job. And truth be told, their employer isn't really an advisor of any sort. So they don't really understand the true value in having different types of assets, whether they're cash flowing assets, appreciating assets, but having assets that grow in a tax deferred manner that set you up for retirement by the time you get there. And that's really when I think financial freedom, I think tax-free income is how I think financial freedom. It's getting Uncle Sam off of our backs. Mm-hmm. And one of the greatest vehicles anybody has is the ability to use a retirement account to create tax-free wealth. And what we focus on here at Directed IRA is not teaching people how to invest in stocks and bonds, because that's kind of by default what people do anyways. But it's to let people know, hey, you can own anything in a retirement plan besides life insurance contracts and collectibles. And most people don't even know that they have other options outside of the options that they're sold at their Fidelity or Charles Schwab through their advisors. But I've seen life-changing events happen through clients that I've had over 13 years that have found true financial freedom through investing their retirement account in things like, cash flowing rental property, commercial multifamily, syndications, land, all these things that we call alternative investments that people know they can invest in with their personal funds, but they don't know they can invest that in those same investments in their retirement account, and the retirement account isn't a taxpayer. So just understanding the mere fact that, you can invest in other things outside of Wall Street and invest in things like Main Street and maybe investments that you understand better. That's really how you get to financial freedom is utilizing the vehicle that we have available to us, but strategizing your investments to create you income in retirement tax-free and pass on more generational wealth, which I hope we talk about as well.
Well, that's a big piece of it. I think passing on, and there's certainly strategies to use through the retirement accounts that, again, you at Director IRA with the education. And education is the key. I think people are listening and saying, that sounds great, David and Nate, but man, I got to learn something here. Well, yes, you do. Yes, if you're going to learn to be just like you learn anything in life, you learn trades, you learn technical skills, you operate a business, you had to learn things, right? Well, learning about how to navigate and shepherd your money, your capital, retirement accounts or taxable accounts is really, really important for people. And a lot of people just felt like they could just, give that to somebody else to deal with. Not demeaning advisors. You need advisors around you, but you've got to be the orchestrator. And to do that, you've got to learn. Education is the key. We do that at Freedom Founders. You do that with your clients at Directed IRA all the time. We're also talking about, Nate, and you mentioned it, is Wall Street is kind of the default where people will buy the stocks, bonds, mutual funds, ETFs, et cetera. Most traditional retirement accounts, that's where they're invested because it's easy for the employer. As you said, they're not advisors. They're not in a position to do that. So they try to make it easy and provide a benefit for their employees, which is great. Having the opportunity to understand how an employee at the right time can take their capital and become more intentional about it. Diversification, I think today is a word that is out there, but I think it's more important today than maybe it's been in the last 15 years. Do you want to talk about that a little bit, about diversification? You mentioned a little bit, but Why do you believe, just from your own standpoint, Nate, that diversifying, some money out of Wall Street, not saying take it all out, but some money, why are some of the alternative investments? And maybe describe a little bit for our audience how you look at alternative investments, because certainly through Directed IRA, the landscape is wide open to the alternatives that are available to self-direct one's capital.
Yeah, well, I'll talk about my personal experience and then I'll talk about it globally. How I even found self-direction was really by chance. But prior to working in this industry, I was working as a loan officer in the real estate market, in the real estate business. I had 17 rental properties at one time before I even understood what an IRA really was. So I had a knowledge base in real estate that was greater than my knowledge in the stock market. And if I'm speaking to anybody out there, ask yourself, do you understand what makes the stock market move? Most people don't. They just, like you said, they invest in it because that's their default investment. But for me, at the time that I found self-direction, I was becoming an expert in real estate. I was becoming an expert in lending. I had a retirement account at Northwestern Mutual. It had a mutual fund in it. It didn't really go up. It didn't really go down. It just kind of stayed the same every time I got the statement. But had I known back then that I don't have to invest my IRA at that time, my Sept IRA, I don't have to invest it in stocks. I could invest it in the things I was knowledgeable about. I could invest that IRA and own a rental property. I can have that IRA do a hard money loan to a real estate investor. These were the things that I was already doing outside of the IRA. I didn't know I can do it inside of the IRA. So for me, I've made a pendulum shift to have most of my retirement assets in the things that I understand, because that's how I make the needle move with my retirement account. Now, everybody's knowledge base is different, but I would ask, are you knowledgeable about something more than you're knowledgeable about the stock market? Well, more times than not, that knowledge can be applied to help your retirement account grow, because like I said, you can own almost anything inside a retirement plan. But when you look at it globally, when you look at the actual numbers of retirement plans, and you look at the ultra wealthy, what the ultra wealthy do with their retirement plans, it's pretty shocking to see the difference between what the average American has as far as what we call an alternative investment goes. And alternative investments are just anything that are not based on Wall Street. We're talking, rental properties, land, cryptocurrency, cattle, private businesses, startup businesses. These are all kind of encompassed in what we call alternative investments. When you look at the average American with a retirement plan, less than 5% of Americans have an alternative investment at all inside of a retirement plan. But when you look at the numbers, people only wind up with about $150,000, $200,000 in their retirement plan, which is not enough to retire on, especially today. But when you go up the chain a little bit, and you start looking at what are the wealthy doing with their retirement plans. Well, we've seen from recent audits that clients or investors that are worth $1 million or more, 22% of their assets are alternatives, right? Only 5% people under $1 million. Once you get to $1 million, 22% of the assets in those retirement accounts are alternative assets. And then you go to the ultra wealthy, the 30 million people valued $30 million and above. They hold nearly 50% of their assets in alternative assets. That is not by mistake. That's by intention, because the rich and the wealthy have been investing retirement plans in alternatives since it was allowed in the mid 70s. And if you look at that globally around the world, 80% of retirement plans around the world hold alternative assets. So it's not by chance. The rich and the wealthy have understood that if they understand an alternative investment, they can make better returns, in some cases far better returns than what the stock market provides. And I'm not saying the stock market's bad. By all means, invest in the stock market, especially if it's going up. But I think everybody needs to understand that that's not the only option. There's so many other options outside of Wall Street, and you can own different types of investments inside a retirement plan. And for me, it's about applying my knowledge to my retirement plan. And that's how I see it grow. And that's why I become so passionate about teaching this, because I realize we don't get this education in school. We don't get this education anywhere else except webinars like this, right? Where you hear it or you might hear it from somebody else. But I think everybody should understand that they have more options with their retirement assets.
So you're right, Nate. Stocks, bonds, mutual funds, anything on Wall Street is relatively easy to invest in. You can do it yourself. You can have a broker advisor to place capital for you. It's very, very passive, and you don't really have to do anything. So it feels good because I feel like I'm putting money away for the future in a retirement account, and it's going to build for me. But the models are shifting and changing. The difficulty some people might be thinking is, okay, it sounds great. I've got experience with some of the alternatives you mentioned. Maybe I've got some rental houses, or I've done some lending, or I'd certainly like to see how I can invest in another kind of business. But it sounds hard, Nate. It sounds like there's not an easy button I can go click and make that happen. Let's talk about that, because that's kind of the elephant in the room. It's nothing in life that provides fruit is easy, but how can it be easier than trying to do it solo?
So I think for our industries, technology is really catching up in the self-directed IRA space. And when people, say, and you often hear this from advisors, if somebody hears this program and they go to their advisor and they say, hey, I heard, this guy, Nate and David, talking about I can own alternative investments inside of my retirement account. A lot of those advisors are going to tell you how risky it is and how hard it is. Truthfully, what makes it hard is not the IRA, but it's more what you're buying, right? We're not logging into our Fidelity account and buying a stock, but anytime we buy an investment through our retirement plan, we always have to work through the custodian of the retirement plan. So in most cases, Fidelity is your custodian. In our case, directed IRA is the custodian. But when we're deploying funds to buy an investment inside of our client's retirement plan, it's an investment that has more moving parts. It's not the IRA that has more moving parts. Real estate has more moving parts. So there are, companies, and I like to think we're one of them, that make the process easy to buy an alternative investment with a retirement plan. It's really a 3-step process when you break it down: open an IRA, fund it, invest it. The investment process, we've got a team of individuals that are experts in different alternative investments. We've got teams broken up that specialize in different investments. So we make the process as easy as possible, but there are some more moving parts to investing in an alternative. The question is it worth the extra work? Am I going to get better returns investing in an alternative? And by no means, you don't have to pick one or the other. When you go back to that diversification comment you mentioned, the best investors on the planet do not have all their eggs in one basket. They keep an IRA at Fidelity or Charles Schwab that holds their stocks or mutual funds or ETFs, but they also have an IRA with a self-directed IRA custodian that allows them to buy alternative investments. If you look at family office invests heavily into alternative assets, and they're working with, numbers of 50 million and above. So you want to think, when you want to think diversification, don't get bought into the fact that diversification is having a high risk mutual fund, a medium risk mutual fund, and a low risk mutual fund. That is eggs in one basket. You're just diversified amongst one asset class. But when you start looking at the other assets that are available to be owned in a retirement plan, the ability to diversify into public assets and private assets is real true diversification. And if you think about it, most of the investments we see, for the most part, I would say, are real estate based, right? Private real estate investments, private real estate funds, right? Rental properties, things like that. When I think of an investment like that versus a stock, if you're thinking about diversification, you also want to think, how tangible are my investments? Is a stock tangible? Well, if I invest all my dollars in a company and that company goes bankrupt, I'm left with zero. I have nothing. I have no recourse on that investment. I just have to buy, hope, and pray that that company does, performs the way they're supposed to perform. But if I own a property, if I own a 3-bedroom, 2-bath rental in my IRA, it's almost impossible for that investment to go to zero, because it's an investment that you can drive by, touch, and feel. It's sitting on a piece of land, and land's not going anywhere. So the fact that you can hold more tangible assets versus just a bunch of stock, which I think are just paper speculative assets, the ability to hold tangible assets is a wealth preservation tool. You can even throw gold and silver and precious metals in there as a wealth preservation tool. But the thing with real estate also that you get is you get cash flow, you get appreciation, you get multiple streams of income. So if you're thinking diversification, you want to think, well, maybe I want some speculative investments over here, but I want some investments that provide tangibility and cash flow at the same time.
Really well represented, Nate. So again, I'm trying to think through our audience who maybe are starting down this road or curious about this road. Like you and I, and probably our audience, we like more control. The tangible aspects of the alternative space is something that I like that, because, as you said, I can assess that much better than I can trying to figure out what's behind the paper, stock, or bond that I've got. Who knows, right? We just hope and pray. Here's where, again, the hard part, and this is where I know that Directed IRA hosts great conferences. In fact, I'll be speaking at one coming up next month in Phoenix and Scottsdale.
Yeah, I'm excited to have you.
And you'll be at our Real Wealth Conference in October in Dallas. Let's talk about the benefit of being around other like-minded people and being able to source and have conversations, even to some degree, do some due diligence through social proof of what other people have done. What's the benefit there to someone who's looking from the outside in going, well, I don't know where to start. I know something about real estate, maybe I have real, but maybe there's more. Maybe there's more I could do. And to see the broader scope. What does a conference or a meetup do for people?
So we at Directed IRA, we don't sell investments to clients. That's one of the things that makes us different. With a self-directed IRA company, we don't have a menu of investments to sell you. You as the client have to tell us what the investment is, and we'll tell you how we buy it in the IRA. So most people are, they're probably stuck on the fence thinking, well, I don't have any investments. How do I find these investments to tell you to invest in? And this, for me, and I don't know if you'll attest to this, David, too, but this is where the fun part begins for me, because when you self-direct an IRA, it's a little bit more of an entrepreneurial type of IRA. You're forced to be intentional. And one of the greatest things that comes along with that is you got to get your butt out of your seat and go network. And there's some phenomenal networking and educational opportunities out there through Freedom Founders, through Directed IRA. One of the things that we do on an annual basis to help our clients maybe spur them along in finding deals or finding access to deals is we do what's called our Alternative Asset Investor Summit once a year, where we bring in different speakers from across the country that only educate, they don't sell. They talk about different investment strategies in the alternative asset space. And then we have about 300 of our clients attend. And a piece of that event is the networking aspect of it, the shaking of the hands, the meeting people. This is where self-directed becomes intentional. But for me, this is actually the fun part. I've met more savvy investors through networking at self-directed IRA events than I ever did working in the corporate world as a loan officer or a real estate broker. So getting out there and meeting people and just learning more, by intention, that you are being intentional with your IRA, but you got to be out there and you got to network. But again, to me, that's the fun part about this business.
Yeah, it's what I call the hallway talk. There's always the stage presentations, which are very informational, educational, but then there's the other people who are on the same pathway. And some of my best friends, well, let's just say right there, Nate, you've been a long time cohort colleague. That's how I met you. And so you find some of the best friends, even people that you may find the opportunity to do business with. And again, we won't get into the rules and regs of self-direction. That's what you do so well. But the ability for me to invest outside of my family, which is important with self-direction, other people that have other opportunities. There's so many ways to do it, and the strategies just build on themselves. And being in that environment where other people are doing the same thing, it really is inspiring. And I think the key thing is people find for the first time in their life that they can do this. And you can start small. You can start small. You don't have to take all your money out of the stock market. You take tranches out and just start taking some action. But the whole key for me in helping other people is like, take some action, get the ball rolling, start small. If you're afraid, it's okay. Skeptical, sure, no problem. But take some action, because you'll find in time, if you stick with it, just like building any muscle, right? It'll start to build over time. And then most people get excited about it, as you and I have been very excited about it over a number of years, not just for ourselves, but again, for family and legacy. So I would say at this point, Nate, we've covered really a broad view of what self-direction can offer. And I think that's really the purpose today. How can people get in touch with you, the company, Directed IRA, to get more information?
So I would just say go to our website, directedira.com. If you want to schedule a call with myself or Michelle Rodriguez or anybody on my team, all you do is click the schedule a new account call. And you don't have to open anything, but this is an opportunity to talk to our team of IRA specialists that are well-trained on how these self-directed IRAs work, and just have a conversation with us. It just starts with that. Ask us questions. We'll explain the process to you about, what's the difference between an IRA you have now and an IRA here. There really is no difference. The process of transferring money over, how that works. We'll talk about the different types of plans you have. You may have plans right now that you didn't realize could be self-directed, like a health savings account or a educational savings account. But I say go to directedira.com, click the button, schedule new account call, and talk to myself or anybody on my team. And that's the first step in this process.
Perfect. Nate Hare, thank you so much. I look forward to seeing you next month, at least a couple times. It'll be a pleasure.
I'm excited. Thanks, David.
Take care. We'll see you later. One of the really good guys. And another really good guy right here, my good friend, Eric Goodman, Goodman Capital. Eric, good to see you today.
David, it's wonderful to connect. I hope you had a wonderful Labor Day weekend.
Just picking back up and excited about the fall. Eric, you've done a number of due diligence trips for our Freedom Founders community, and they're one of the most spectacular, highly anticipated events each year. You've done them. Unfortunately, I had to miss this last one, but I know from our tribe, they always come back, and the wisdom that they come back with from your high level of explaining different aspects of the capital stack and the markets. I used to think I knew a fair amount about it. When I first met you, Eric, said, okay, I've got a deeper dive to do here. You never cease to amaze with your knowledge, experience, and your ability. I want to speak also to the fact that, Eric, yours is a legacy capital platform. Your father, Bill, who I've had the pleasure, many people in our tribe have had the pleasure of meeting. It's really what we talk about, the relationships in the alternative space, which is what we focus on a lot, is the relationships that are created, that are built. You can do those yourself, which I have over the years with my smaller portfolio of properties, or when you want to maybe deploy large amounts of capital and be a little bit more passive. I still look for people that have legacy companies, businesses with culture, with values, and the relationships, because that's what makes everything tick. You want to talk a little bit about that? You're a humble guy, but man, what you and your dad and your family have built, it's pretty amazing.
Hey, I appreciate that, David. And I'm really grateful that there's that energy within the Freedom Founders community to really learn and understand, because I find the private credit space is an often misunderstood space. Today, it more so now than ever is it in vogue. And the good news with that is that it creates a greater awareness of the space. Unfortunately, it also brings out some of what we call the strategy drifters, those who are kind of bumbling from strategy to strategy, trying to hit the highlight of whatever is in vogue, but don't really have the core expertise. And as you mentioned, the legacy relationships. As a family business, we've been in the New York City private lending market since 1987. So for 38 years, all we've done is source, structure, underwrite, originate, service, foreclose, through bankruptcy, workouts. We've done the whole loan life cycle, and we've done it hundreds and hundreds of times. We've been private credit when private credit was attractive, when it wasn't attractive, when it's back to being attractive. Because the reality is, when you're in an industry this deep, you're finding opportunity across all market cycles, and that's what happens when you're really diligent and really focused. And to your point on the relationship side, keep in mind, right? This is not exactly there is a brokered element to this industry. We steer clear from it because, let's be honest, broker deals are never your best deals. We always say the best deals are structured deals. We've never closed a transaction that was facilitated us in the way in which it was presented. We'll get transactions all the time presented. Goodman, here's a great transaction, and we'll identify 5-6 key areas of flaws, and then we'll take it back to the team. We'll kick it around. We'll bring in the legal in-house team and say, how would we restructure this to actually financially engineer a much more attractive LTV at the right rate of return, and really engineer a strong risk-adjusted return. And that's always how we've run our business. It's very relationship-driven, but at our core, we're a legal powerhouse. We're an in-house team, 10 investment legal professionals. All we do is private credit structure and underwrite. We're really a team of underwriters, and that's really the team you need if you're going to be successful in the long term in this industry.
I think we should define, because we've got a broad audience this week, Eric, and you've thrown out some terms that some people are familiar with, but others not. Private credit sounds like banking. Is Goodman Capital a bank? Help me understand a little bit what private credit is.
Sure. To take the industry to step back, this industry used to be called shadow banking in the immediate post-Great Financial Crisis period, right? It's an industry defined as non-bank lending. So in the pre-Great Financial Crisis, pre-Dodd-Frank, pre-Basel III, regulatory regimes that I helped and other many banking institutions, when I was a banker at Lazard, I was an M&A banker covering financial institutions, we were helping to draft the legislation that's in place today, known as Dodd-Frank and Basel III, that curtailed bank lending for certain types of assets. It used to be back in the 80s and 90s, you pulled up bank rate sheets. Banks were giving private bridge loans, loans to non-bankable borrowers with limited credit, financing properties that were non-stabilized, non-cash flowing. In the post-Dodd-Frank period, that's a no-go territory for any kind of regulated lender, especially now, even more so after the March 2023 banking crisis and the new regulatory reform. So we think of private credit. Private credit's actually a very large industry. It's about 1.7, depending who you ask, $1.7 trillion industry, and it's really the non-bankable, the non-bank lending sector. So think of this as private business lending, equipment finance, aircraft finance, real estate asset-backed lending. It's a very large. It runs the gamut of sectors. Private credit. It's effectively anything that's non-bank lending. Now, within that large range, we focus specifically on real estate-backed lending. So it's even a segment within asset-backed lending, right? Because there's aircraft lending, there's other collectibles and other types of lending. We're specifically real estate-backed lending, and even within that, we're a niche within a niche. And I always find the value is in the niche. It's not in the general. AI and ChatGPT can solve your problems for generalities. Value is driven by having a niche expertise in a niche market, and that's what we do. We finance first lien, senior secured, low loan to value private lending in the New York City market. And that's all we've done for 38 years.
So shadow banking, private credit, sounds like it's not as regulated as institutional banking. I mean, you alluded to that because after 2008 GFC, the regulations came in and really took away some of the particular lending that the banks were doing. So shadow banking, private credit came into play. If it's not as regulated, then is it risky?
So it's a great question, Dave. It can be, depending on how you structure and how you underwrite. You have private lenders that will lend to individuals, corporate borrowers, and they'll go higher octane type lending. you can lend at a 30 loan to value, which is where we're in that called sub 35 to 45, 50 LTV space. We do a lot of acquisition financing, borrowers who have very time sensitive needs or have complicated financing structures that may involve multiple parcels of collateral, may have certain needs that need to be closed that are way outside the scope of banking. Those can be structured in a very safe, frankly, better than bank lending type way if you're at the right loan to value ratio of loan amount to property value. But you can also play this industry in a very risky way. You can finance speculative land in secondary and tertiary markets. You can finance 75, 80, 90 loan to value. And maybe you think you're getting compensated for the rate of return, but in my opinion, that's taking real principal risk. And the one area we never compromise on is credit risk. All we think about is how are we managing our principal to safely and securely manage capital on behalf of our clients, generate wealth slowly, structured way, in a structured, conservative way, while managing principal risk. At our core, that's what we're managing is principal risk.
So really what Goodman Capital does in private credit is really filling a void that I'll call it the retail institutional, what most people think about is institutional banking, cannot adapt to. And you're not making risky loans and charging shark interest rates because that doesn't work for anybody. But as you said, you're structuring for the right borrower at the right LTVs, loan to value, so that you mitigate the risk, but are providing access to capital that otherwise good operators in different kind of structures and scenarios need that capital to make the next move, and eventually maybe they move to refinance or sell into the retail market.
That's spot on. Look, there's a real capital vacuum going on right now in the post-March 2023 banking crisis. We've lost the big commercial real estate giants, First Republic, Signature Bank. I mean, these were stalwarts here in New York, transacting billions of dollars a year. So who is filling that cap stack? It's now being filled by the private credit segment. And different size transactions, necessitate certain types of lenders, not, Apollo, Blackstone, they're in the private lending business, but they're doing deals 100+ million. Who is financing and funding the institutional borrower, the ultra high net worth borrower in that 10 to 50, $60 million space? That's the sweet spot that we're filling.
Let's talk a little bit about interest rates. I know that's something you look at all the time. Interest rates for many years coming out of the GFC, federal funds rate, near zero. And then we saw a huge spike, really a unprecedented historic rise in the rate from 2022 to 2023. And it's remained pretty much there. Seems like all eyes are on the Fed and what's going to come up this month, right? And people look at that. Give us, again, a short shrift on how you look at interest rates. Where are the concerns, maybe not for you particularly, but concerns in the overall marketplace, which may also create opportunities? What's the play there, Eric?
Sure. Look, there's a lot of grappling the Fed is having to do right now. Obviously, there's interplay with governmental policy and, questioning the true level of independence between, fiscal and monetary policy. And what that upholds. Look, we're seeing elevated rates, the likes of which we haven't seen in 20+ years. As a private lender or alternative lender, the risk we need to be managing today is downside risk, which is the risk that there are significant, precipitous, or at least in the next, call it 12, 24 months, drastic rate cuts, to invariably to combat the flip side, which would be more of strong recessionary pressures that may or may not be felt right now in the economy. The last 24, 36 months have been the golden days of private credit, broadly speaking, for the entire $1.7 trillion asset class, because today you can really get compensated for the level of risk that you're taking in the private debt side. Years before, I remember very vividly how difficult it was to be able to charge borrowers a rate of return that compensated you for the level of risk. Capital was abound. We were, the system was flush with liquidity. It was actually very hard to price risk. Today, you can do so because of that. The capital has been flushed out of the system. Now, how do you think about the next 12, 24 months? When we're structuring our loan portfolio, everything in our portfolio is floating rate. It's as clear to me as next year's weather, whether the Fed's going to raise or lower rates. So if rates go up, you're prepared with a floating rate portfolio. How do you manage the risk that we don't see a pretty strong rate cut over the next 12, 24 months, especially if the Fed 10 are coming up? You have to insert what are called interest rate floors. This is a unique structure that we've implemented for decades in the underwriting side of our business. And it's a fixed floor rate that ensures the borrower has to pay a certain minimum interest rate. And by extension, that portends a certain minimum level of return for investors. right? Because as an investor today looking in the private lending space, you got to be very worried. How's my sponsor going to manage returns for the next 12, 24 months? I could get in today, but if we start seeing a bunch of rate cuts, is my net 10, 11 div yield going to drop to 6 and 7? How do you mitigate that? You insert what we call high interest rate floors. And all of our loans, they're all floating rates. So we get the benefit of the upside, but we also cap the risk on the downside in case we do see a rate down cycle by hitting that minimum interest rate floor, which typically gets set at closing, just to ensure that we can continue remitting the same tax advantage dividend yields we've been doing historically.
So that's really good on mitigating the downside and maintaining the returns that your investors are used to, or I guess would expect. What kind of opportunities do you see coming up, or maybe have already come up with the rates that have increased so much in the last couple of years?
What's interesting about opportunity, I find opportunity generally is usually born from uncertainty. Once there's certainty in the system, people can adapt, they can react. So when you don't have certainty in the system and there's confusion, concern about where rates going, that's usually the interest and fulcrum moment when the greatest opportunity presents itself. We're finding today, just like we've had the last 2-3 years, because of how we're pricing our loans, we're not doing the high octane lending. We're focusing really at what otherwise in a normal environment would have been the bankable borrower. And there are very few lenders at that space. So we're talking about lending to ultra high net worth professionals who own legacy real estate portfolios. We're talking about very wealthy families who have owned properties for decades. They're not equipped or mentally prepared to pay a 14, 15% interest rate to a typical hard money lender. Their banker is not quoting business because the bank may be sidelined. Who's filling that gap between the 10 to 11% space for alternative financing? That's really the space we're playing in. So the majority of our portfolio in the last 4 years, we've closed $750 million of first lien mortgage financing, blended 40-45 first lien LTVs. We're hitting a net 9 to 10 for investors, and that's really the sweet spot where I think you're getting compensated for the level of risk, which is quite diminished when you're structuring a sub 45 LTV, but the right level of return to preserve and build that relationship, that borrower relationship for the long term. So that's where I think I see the opportunity. The multifamily, great core assets in prime New York City submarkets. Really, the borrower that was left saddled by the bank that went under. That's the typical client that we're financing today.
Yeah, the access to capital at rates that are sustainable for particular projects or borrowers, it's what drives everything. Many investors, including myself back in my early days, looked at alternatives, particularly real estate, on the equity side. Started out with rental properties, and maybe people have done some work with people who have syndicated equities in multifamily and self-storage, and certainly going back just a few years, even through COVID and maybe the year or two after, saw some huge spikes in equity values. Now we're kind of flipping that around because of the interest rates and kind of a drag on returns and margins and labor costs, supply costs, tariffs maybe. Private credit is something that I think a lot of people are not aware of. That's why I wanted to really talk to you about today. That side, I became aware of it maybe a few years after I started back in the 80s and started to understand, the benefits of maybe having plays on both sides. And there's times when maybe you want to tip your allocations maybe more towards equity if you feel like that's where it's going. But boy, I love the safety and I love the recurring sustainable income that can be derived from the credit side, which that replacement income is what so many people are looking for particularly when they're leaving active income, Eric. We have a lot of people in Freedom Founders who are selling their practice and they're saying, well, equity and growth is great if it's there on the table to have, but boy, I really want the replacement income. And I think that's where private credit really shines.
I agree. And I think, no less important to highlight where you are in the cap stack and the seniority in the cap stack and the safety that affords you being in the private credit space. And candidly, in my opinion, private credit, and as it's been for us for 38 years, is one of the true places to earn reliable monthly passive income in a safe, risk-adjusted way. It's what we've done for 38 years. We'll do for the next 38 years. It's really a unique segment in where the interest rate market is today. Strong underlying real estate fundamentals, but the reality is it's hard to earn that risk-adjusted return on the equity side. Today, I think there's no better place to be investing, at least for today, for the next year and the next 3 to 5 years, than the low LTV, low risk private lending space to earn truly monthly passive income without the headache of being a real estate operator and having to worry about equity value compression.
Very, very good, Eric. What's the best place for people to connect with you and Goodman Capital?
So to learn more about Goodman Capital and our various upcoming investment offerings, check us out at www.goodmancapitallllc.com.
You're going to be with us as you have been for multiple years at our next Real Wealth Conference in Dallas in October coming up. Just for folks that are listening, they're interested. This is the day before our early bird ticket pricing goes away. Tomorrow's the last day for that. So if you'd like to be a part of these conversations that you've heard maybe this week, today, we would invite you to take a look at the link that Nathaniel put there for you. It's going to be a great event, and these kind of conversations are the same ones that we have right there at the event, mixing up with other people who have their own experiences and what they've done. And I think there's no better way, Eric, than being with other people, like the due diligence trips that you've provided for many investors to come really boots on the ground, see what other people are doing, and really learn about who the jockey is. The jockey being, who's taking care of the assets that one might be investing in. Eric, I really appreciate you being here today. It's always a pleasure, and I'll see you in a little over a month.
Looking forward to it, Dave. Thanks for having me. I'll see you next month. Take care.
Thanks for your time. Appreciate it. All right, great conversation, and I've got another great one coming up here. Don Winter, Don, DLP Capital. It's great to see you. I think you're just your audio. There you go.
Hear me now?
Yep, you're on.
All right, awesome. Pleasure, David.
Perfect. Well, thanks for your time today, Don. We've been having some live streams this week, as you know, and I definitely was excited to include you. I was talking a little bit earlier today about legacy businesses. You and I could get into the weeds of different types of investing, and we can talk a little bit about that. But I think what's most important for me, and I know what's in your heart, is the good that you're doing, not just for yourself, but for so many other people, with building a business, DLP Capital, that started, I guess, almost 20 years ago, if I remember correctly, right? Bethlehem, Pennsylvania. And talk a little bit about the values. We can get into the economics, but I think it's so important for people to know like who they want to invest with, particularly when we're doing more self-directing of our capital today into alternatives.
Yeah, thanks, David. Love that question. I like that even more than talking about investments.
So, I thought so.
So I think the way sometimes I think about it is, I don't think it's a surprise to most people to hear that employees want to work for purpose-driven companies, right? That's become kind of pretty known to a lot of people over the last maybe 10, 15 years. And that today, when you're looking to recruit the best talent into a company, no matter what business line you're in, right? Whether you're in real estate investments or you're in dentistry, people have a lot of options. The best people have lots of options, and they want to work for companies where they feel connected to something bigger than themselves. Which is why I think it's so important to understand purpose in the organizations you're investing in, because in simple ways, I like to think about it is if the best people want to work for companies that are purpose-driven, that means that the companies that are purpose-driven are attracting the best people, which means they're going to have the best performance. And so the purpose at DLP Capital is to transform lives through the building of thriving communities. All of our investment funds are impact investment funds, mandated first and foremost to provide housing that's affordable to working families. But affordable housing, if you thought of it as like a pyramid or say a continuum, I think of the base is housing that's affordable. People need a safe, affordable place to live. That's where sort of everything begins. Until they have that kind of foundation, it's hard to then focus on the other areas of life of what that are really important to actually be a part of a thriving community and have the opportunity to impact and transform lives. So when you think of impact investing, not a lot of people really know what that means. But those who do typically think of it as you invest in something you believe in, and you're willing to accept a lower return to make a difference. That's not what we do. That's what you would call concessionary investing, where you're saying, hey, I really am passionate about homelessness, so I'm going to make an investment. I won't get market returns, but I think I'm going to make a difference on this cause. We provide housing that's affordable working families, which is a problem everywhere in this country. But we actually think that's part of our value proposition and part of how we actually generate above market returns. So transforming lives through the building of thriving communities is our purpose. That applies to the 100,000 residents that live in our housing communities. But it also applies to our investor community. And so we are blessed to have 3,600 families invested with us, many members of the Freedom Founders community. Thank you, David, and thank you to those listening. And we really want to pour into our investors' lives. Hence why we're doing an event right after yours, David, on legacy and impact, right? And we bring in people like David Green and John Maxwell and Tim Tebow, learning around how do we be great shepherds to the responsibilities to our families, to our communities, to the resources that we've been each blessed to steward.
Well, purpose is so important in life, Don, and I can speak for myself, but oftentimes when we're young in life, we're just trying to make ends meet, right? Get something started and not usually thinking about legacy and purpose. But what I love about our ability to invest through the culture and the company and the values that DLP has provided is you are making a difference, and we get to directly, indirectly make a difference also. I know the stories, and you got many stories, and I think it was you were doing a session with our group not too many weeks ago.
Yeah,
and you're talking about back in the early days when in your evolution, just about the impact that you made. And I think it's that impact that really is the satisfaction. Making money, earning good returns. Yes, that's being a good steward of one's capital. Important. But how is that capital? How is that investment impacting other people where you can actually see, feel, and touch it? That's what I love to be a part of. You go on many mission trips also. I'll just say that. So you're always out there giving back, and your entire community at DLP is about that. As you said, your conferences talk more about impact than we get into the nuts and bolts of what are interest rates doing today, right? It's important. I know your team's all over that and making good decisions, but the larger impact is what's more important. One more piece of that, and you alluded to it, Don, is really the chasm in wealth inequality we have today, and it's just been growing over the last number of years. Where we have people that have been the benefactors of holding assets of certain kinds, small tranche, maybe it's the upper 20%, give or take. And then we have, the middle class, which has been getting squeezed, hardworking, diligent people, W-2 wage earners. And, life is never fair, but you can say it's been pretty unfair to hardworking people in that category, speaking to the unaffordability of housing. Well, we've seen that play out big time since COVID for a lot of reasons we don't get into today. But the fact is, what do people want, whether they're a stable family or maybe a single parent trying to raise a family? Well, they want safety and security. They want a place where they can afford to have that safety and security and not be forced into parts of a city or a town where they have to worry every day about safety. Speak a little bit more about that and how you all will serve that market and keep those tenets of safety, security, a community for people that are looking for that, but not have to price it so high that they can't even have access to that.
Yeah, I love that question, and it's a big part of what we get to do. So just a couple quick stats. Right now, out of the homes available for sale in this country, only 14% of Americans can afford the average home for sale. 14% of Americans can afford the average home for sale. So home ownership, especially since, as you said, since COVID has become out of reach for many people. Of course, that's home prices, that's interest rates. So that forces, if you can't afford, only 14% of people can afford to own a home. Well, then of course, there's only really one real alternative, which is to rent. Well, renting is now unaffordable to more than 50% of renters, meaning 50% of those who are renting cannot afford their rent. That's a simple way of saying they spend more than 30% of their gross income on rent. And that's thought to be the max of affordability is 30%. I'll give a kind of explain what we do in a couple quick stories. So I have a resident named Jessica, and Jessica has 3 kids, a 4-year-old daughter, a 6-year-old daughter with special needs, and an 8-year-old son. And her 4-year-old daughter, and so Jessica is an HR manager making $80,000 a year, and she's living in an apartment. And I should rephrase, this is a past situation where she was living before, but she was living in an apartment at, I think it was $2,500 a month. And so it was 35% of her income, even though she's making, you could say, a good income, $80,000 a year, was going just to pay rent. And that's, again, thought to be the threshold. If you're spending more than 30%, you're having to sacrifice basics of education, food, healthcare. So again, Jessica, 3 kids, 4, 6, and 8. Her 4-year-old daughter had 102, 103 fever for multiple days. And Jessica had to make the decision: does she take her daughter in to emergency center or into urgent care, or does she pay her rent, right? And so for many of us as parents, could you imagine being in that situation where you have to decide, do I seek medical care for my child, or do I pay my rent? To literally have to choose one or the other, because if she goes in and racks up $1,000 medical bill or $500 medical bill, her expenses are so laser thin, her margin each month, that she won't be able to make next month's rent, right? And that's the kind of challenges that so many renters face. But as you said, David, if I do this thing, I'm in Nashville, Tennessee right now, and I'm doing a dinner event tonight. And when I do this event, I kind of explain this concept. I pull up this kind of program called Slido, which is a way for everybody in the audience to interact with the content. And I ask people, if you were a renter today, living, wherever you live today in the country, and you were renting a apartment, what would you think is most important? What would you be looking for in the apartment you're renting? And so people type in on their phone answers, and there's always 2 answers that come up for most of the people in the audience. The top 2 answers that always come up are the same: safety and community. And so you just said that, well, this factor of safety, but a lot of people think, safety comes from alarm systems or patrol or gates. That's not where safety comes from. People actually feeling safe is very simple. It's that they know their neighbors and their neighbors know them. That when they have an emergency or something going on, that they know that there's people looking out for them. They know if they had to rush to the emergency center with their daughter, that they have somebody's door they could knock on who'd be willing to watch their other kids, and they'd be comfortable letting them watch their other kids. Most renters in America today do not know their neighbors. None of their neighbors. They don't know a single person in the community they live in. The average renter in America today moves every 15 months and does not know a single neighbor. So that's a big part of when we say we transform lives through the building of thriving communities. We create communities where people know their neighbors. We do community events every week or 2. We have a welcoming committee for every time somebody moves in that welcomes them. We have on-site ministry resources who live at each of our communities. Their whole job is to get to know the residents and make sure they get to know their neighbors. We have tons of small groups, from Bible discipleship groups to yoga groups to financial literacy to leadership development to after-school programming for kids to parenting classes. We build communities where people know their neighbors, where they have real relationships, and that's what gives them feeling of safety. That's what gives them the deep sense of community. That's what helps our renters to feel connected to a purpose bigger than themselves, when they feel that they know other people and they get to serve one another. And so I'll just sum it up with a quick story, kind of our approach. So I took over management of a property near Jacksonville, Florida, which is near where I live in St. Augustine, Florida, about 1.5 years ago. And when we took over the management of this property, all the employees, so keep in mind, in housing communities, we have employees that work at each of our communities and in often cases live in those communities. So when we took over this property, we had a staff of about 12 people that now became DLP employees. And one of the things we do for all new employees, probably the same thing you do, David, and many of you probably do in your practices, is when you do a welcome to DLP, welcome to Freedom Founders type meeting for all new employees. So we do that for all new employees. I get the great pleasure of, as founder and CEO, to lead that. And so I'm doing that for all our employees that month, and the staff at this community. One of the things I tell them about is a program we run called our Dream On program. And our Dream On program is like Make-A-Wish, if many of you probably know of. And it started with just granting dreams for employees. And so we've done, vitro fertilization, adoptions, special vacations, home renovations, first-time home buyer down payments, all these kind of things, right? And anyway, so I tell the staff, like I do with everybody, about this program. A couple months later, the manager of this community came to us and said that we had a resident at the community who his name is Sam, who was diagnosed with stage 4 cancer. And he was going to have to go through chemo and wasn't going to be able to work because he was going to be, you know, really intensive form of chemo. So she came to us asking if we would help Sam. So we kind of got our arms around the situation, details, and what we decided to do was provide him with free housing. So we then brought him into the office at the community, and we had him on video. I was on Zoom, kind of like we're doing right now. And we told Sam that we're going to provide him with free housing. And all the staff came around him and hugged him, and there was a lot of crying and you know, happy crying and gratefulness. And that day, we did a whole bunch of these dream ons. I think we did 17 of them that day. A couple months later, I'm out at the property. Actually, it's a few months later. I'm out at the property meeting with the manager, and I was worried the manager might leave us because she was going through some challenges with her boss, and we had some turnover going on anyway. So I'm out there just making sure she felt loved and cared for. And she says to me, "Don, you don't ever have to worry about me leaving DLP." And I said, "Oh, that's great." Her name's Mandy. She says, "Let me tell you why. It's all about Sam." And I said, "Oh, well, how's Sam doing?" It's been a few months now. She said, "Well, he's doing great. He actually went through chemo. He's now back at work, doing great." And she said, "You know, I've been meaning to tell you this, and I don't know why I didn't, but Sam had come to her after we granted him this dream and told her that he was not going to go into chemo prior to us granting him free rent. He was just going to let himself die because he didn't think anybody cared about him." And so she gave us the credit for the dream on, but it wasn't the dream on. What happened was, because we found out about Sam's situation, our staff found out, and the other residents in the community found out, people started caring for Sam. People started driving him to his doctor's appointments. People started picking him up. People started cooking him dinner after he had chemo. People started coming and cleaning for him. So now Sam has a purpose and a meaning to live and is now doing well. But now my manager says she'll never leave the company because she doesn't want to leave this kind of thriving community. And imagine what the other residents in the community think now, knowing they have relationships with one another, knowing that when they go through a hard time, there's going to be people there for them. And that's a thriving community. And that's good for business, because if people feel loved and cared for, they don't leave.
That's right.
Stay in the community, which people stay in the community means we have higher occupancy. When people can afford to pay their rent, they pay their rent. All of these things mean we generate more income. When people feel cared for, they take better care of the apartment they live in, which means we have lower maintenance costs, lower repairs, lower turnover costs. All of this means we generate higher profits. And that's the whole approach we take of building thriving communities. It starts with people being able to afford their housing, but it's so much more.
Well, Don, you hit so much on the head there. It's a lonely world without relationships. It's a lonely world without community. And there's so much of that loneliness, isolation today. Just because of the way that our culture has, with technology and so many things have changed. There's so many lessons there that you brought out. And I think as I think through my life and what I've been privileged to do today, it's relationships and, to your point, community. Community, starting with your team, your staff, whatever you have, but then emboldening what can you do from your standpoint out into your community, whatever that community size is. It could be a neighborhood, it could be a block, it could be whatever size you want and capability. But that's what brings us all together. And so I love the care and the values that you bring. I don't want to leave our talk today without letting people know a little bit about DLP from the standpoint, how can we get involved? And also, just to add to that context, I had Nate Hare on from Directed IRA. A lot of people don't understand that they have the opportunity to diversify their retirement accounts through specific custodians that allow for that, into alternatives like real estate. So give us a little rundown about what DLP is involved in and how we as investors can connect and potentially become investors with you.
Thank you, David. Yeah, and I look forward to hopefully seeing many of you at the event in October. So as I might have mentioned earlier, we have about 3,700 families invested with DLP Capital today across 4 main investment vehicles. And to David's point, we manage thousands of qualified retirement accounts through self-directed custodians, as well as through Schwab and Fidelity and so forth as well. So yes, qualified funds can be a great place to put into funds such as ours. So in simple terms, we're on 4 funds, 2 that lend capital. And I know I just got to hear the last end of the last presenter who does private credit. So two funds that lend capital and two funds that own real estate. All four of them focus on transforming lives through the building of thriving communities, which is anchored on housing that's affordable. So we have a fund that does all senior secured first position mortgages. We run that fund for 10 plus years, generated double-digit returns distributed to investors every month for 130 plus months with 90-day liquidity. We have a sister fund to that called the Preferred Credit Fund. And then we have two funds that invest equity, one that invests equity in existing housing communities and one that invests equity into building brand new housing communities. All of these funds are evergreen, open-ended, private REITs that give you the flexibility to have liquidity and the option to stay in as long as you want. All give different forms of tax shelters. All have historically generated double-digit returns to investors with regular distributions. All are impact funds mandated to provide housing that's affordable to working families. All four of these funds leverage our deep expertise in owning about 25,000 housing units, actively developing about 10,000 units right now. We have a team of 650 driven team members who feel called to do what they do to serve our purpose and to be great stewards to our investors. We've been doing this 19 years. We've been one of the fastest growing companies in America for 13 years in a row, methodically growing the organization in a really, really consistent way. I haven't written as many books as you, David, but I've written two books on one called Building an Elite Organization, one called Building an Elite Career, which is the exact framework playbook to how we've grown our company. But it's also the systems we use to help the companies we lend capital and partner with implement into their businesses. And then I'm writing a new book right now called Building an Extraordinary Organization, which is all the framework to how do you scale a high growth company, but helping organizations understand that they can use their businesses as ministry platforms. And kind of you said a few moments ago, David, a lot of people go on this journey. There's a famous book written by a gentleman out of Dallas, Bob Buford, called Halftime. And Halftime was a bit of more of a remedy than a prescription, meaning it was kind of, hey, if you spent the whole first half of your life just focused on making money, now how do you go and focus on making an impact? My close friend named Lloyd Reeb wrote a follow-up book to that called Success to Significance. And if Lloyd was on this meeting with us, I would tell him this, I would say the same thing, which is that framework is wrong. My approach is success with significance. How do you have significance, make an impact through your business, starting with your employees, carried into your clients by approaching your business, your marketplace for-profit business as a ministry platform? And that's what we get the great joy of doing every day and helping those we deploy our capital with do in their businesses.
Well, friends that are listening today, you can tell that interacting with Don Winter, DLP, you certainly have the opportunity to invest capital, which is wonderful. But there's so many other things you can learn as well for your own life, for your own family, for legacy, the conferences that you have. There's just so much that you provide. I appreciate you being here. I'm looking forward to having you and your team with us at the event in Dallas in October next month, actually, Don.
Yeah, crazy.
And we put the website up. Best way, dlpcapital.com. Any other way that people, I know you've got podcasts, other ways that you'd like people to at least connect or engage that like to follow up?
Yeah. So dlpcapital.com, as David said, on there's an event page. We do lots of virtual content, kind of like this, live events, including our big legacy event coming up just a couple weeks after David's event. You can reach out to us via email as well. It's info@dlpcapital.com, or you can email me at don@dlpcapital.com. And I do have a podcast called Impact with Don Winter. You can find anywhere you would get a podcast.
Very good. Don, appreciate your time today. Have a good dinner tonight in Nashville, and we'll see you next month.
Sounds good. Thanks, David.
Take care. All right. Well, that's going to finish our live stream for today. I hope you've been able to join us some part of this week, or maybe catching the recording. These are the kind of conversations and the people that we bring together at our conferences. The next conference, the Real Wealth Conference in Dallas, October 23rd to the 25th. Tomorrow, Friday, September 5th, is the last day for early bird pricing. So if you're like me and have a lot of good intentions to do something, but like everything else, we get busy, procrastinate, say, I'll get to it when I get to it. There's a little urgency here because, well, who doesn't want to save some money? So tomorrow's the last day. The link is there for you right here on the page here, and you can go there and register to come. I would say to any of you who are aspiring to figure out what your game plan is, for investing capital, for building your business with intention, with legacy, with community involved, and even figuring out what your next is, past active income. These are the kind of conversations that we have in our group. And like Nate Hare said with directed IRA earlier today, at Freedom Founders, we don't sell real estate. We don't have a fund. We don't syndicate. We don't co-GP. Our job is to educate and connect. And that's what you get at our conference. There's no pitching of anything. You're going to talk to real people like Don, like Eric today, like Nate Hare, and others we've had on this week. You get to rub shoulders with them and talk to other people who have also been on the journey, learning how to navigate the economy, to shepherd their capital, and be more intentional about it. I think this is the era where we have to do that. We have to be more intentional about building, maintaining, and protecting our freedom, because what else is life about if you can't live the life of your dreams and you're putting it off to someday, some mystical someday that may never come? I'm David Phelps. I appreciate you being with us this week for the Real Wealth live streams. I hope you gained something from it and would love to connect with you in the future, possibly at the Real Wealth Conference in Dallas next month. Click the link if you want the early bird pricing. I'll talk to you soon.